Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Monday edition of Trader Talk in today's market. I'm your host, Kevin Horner. It is a beautiful day here in Denver, Colorado. Today, I'm lucky and pleased to be joined by a good buddy of mine, Mr. Michael Bruskoff. Hey, Mike, it's great to see you again, buddy. It's been a while. How are things?
Hey, good morning, Kevin. How are you doing? I'm here in a warm, muggy New York. Hopefully it's a little better out there in Denver for you.
You mean July and New York City is muggy? I had no idea.
It's hard to believe. Hard to believe.
Yeah, it's a glorious morning here in Denver. Nice and calm and mild. Of course, we don't get humidity, so there is no mugginess in the Colorado area. It's nice and dry and lovely. Hey, Mike, we have a big show on deck, mainly because we got a big week on deck. We got a lot of companies reporting earnings this week. We've heard from the president already this weekend announcing an agreement with the European Union, lowering tariffs to 15%. So we got plenty to cover. We want to say hi to our friend here in the chat this morning. We are joined by Mike Fairborn. You can make sure you're chatting with him. He's going to get to comments and questions that Mike and I are unable to get to in the show. But I hope it goes without saying, we want to hear from you, everybody. Please be comfy posting in the chat for the duration of the segment. We'll go about 45 minutes and try to bring your questions and comments to bear here in our discussion. Additionally, if you're not already doing so, Mike Fairborn and I are available to you on X. You can follow us there, Kevin Horner CS and Mike Fairborn CS. It's a good way to engage with us outside of the classes we offer you here each week. Now, let's hit those disclosures, everybody, and then we'll get into the conversation quickly here. Remember that our conversation is exclusively informational and educational. We do not make recommendations. We do not make endorsements for a specific approach to trading the market. We do talk technical analysis here, though, everybody. Please remember that we think of that as a piece of the puzzle, not to be making decisions exclusively based off technicals. And beyond that, remember that everything we cover is for your informational purposes exclusively. All right, and then an agenda for you, everyone. Pretty much the same stuff here. We're going to be going through our top-down review. We'll hit up the broadest of indices, leading with the S&P 500, move into the NASDAQ 100, the Russell 2000, probably check on the semiconductors today, and then we'll look at some sector action, get to some stocks that are in the news this morning also. So plenty to cover today, everybody. Mike, I'm going to hit you up with the S&P here. We've been talking about the strength of this rally built against the 20-day moving average, the consistency of that 20-day being so strong. We finished with day 65 last Friday, Mike, above the 20-day. 65 consecutive closes in the SPX over the 20-day. Pretty good run here.
That's a great run, Kevin, right? We'll take it because if you look at as I'm looking at your chart right now, you look at it probably had about 40 days below the 20-day moving average right before that. So you give a little and you get a little.
Yeah, but it's been about a bunch more because we don't have any give back. A lot of our give back have been very limited in scope, 1 day, 2 day, and then we are right back on it. It seems that there is a lot of buying interest every time we get a pullback. And I have to wonder, Mike, at some point this has to run its course, right? At some point, we're going to get tired of continuous push into these upper regions. We have to think that a break of the 20 days coming at some point. Of course, trying to peg that is as difficult as anything else. I certainly don't want to encourage traders to be going against the trend. That's not a smart decision necessarily. But what kind of conversations are you having with people in your branch conversations, your chats with clients at this point for those who are maybe growing a little weary of this move? I mean, 3 months to the upside with no give back is pretty crazy. It's getting a little long in the tooth, no?
No, Kevin, I'll agree with you. We're looking at the S&P 500. I think I saw, don't hold me to the exact number, the 15th new high of the year. We had, 4 new highs in a row last week. The NASDAQ, maybe one day higher, maybe 16 new highs this year. Hey, Kevin, I was off last week, which doesn't affect our conversation for today, but I was thinking about it over the weekend. The market, and it's an old Wall Street adage, the market climbs a wall of worry. And you just said it. how much more can we keep doing? We've got this, we've got tariffs, we've got that, we've got everything else going on. And yet, as you just said to me, what was that number, Kevin? 60?
65 closes in a row.
65 closes in a row. And if I asked you over the last 65 days, Kevin, is there more positive or negative? Zero politics, as you know. Hey, we've got the tariffs. We don't know if we're going to have an agreement. We don't know this. We don't know that. And yet the market has continued to march on. We're sitting here at all-time highs as I'm talking to you. So while I kind of human emotion kind of tend to agree with you that, hey, how much more can the market keep going up? That wall of worry is what keeps the market moving, keeps you interesting, keeps me interesting in talking to clients, because people are always concerned about something. The something obviously always changes, but we're getting some good news out there. Now, we'll get into tariffs and stuff in a little bit, but have we front loaded the Q1, Q2 earnings with tariffs, and maybe we'll see more of those potential effects second half of the year? Maybe, maybe not. Or is this just going to be how the market kind of runs? But it's been a great run. And I think, from your viewership, from, your perspective of talking about the market, it's always easier to talk about a market that's going up than going down. That's what I would say.
Well, of course, obviously, it makes it a little bit easier and certainly more fun from a conversation standpoint, albeit at this time, it's starting to grow a little weary because we just keep saying the same old stuff. And I hope people aren't growing themselves, getting complacent, because that's kind of the risk factor for traders at this point, everybody, is complacency. And what I mean by that is simply not addressing your risk factors on your individual portfolios. And you take a look around at your portfolio, if you're over-invested at this moment, you're probably feeling okay about it because the returns are coming through. But at some point, things will change. And so my encouragement is the reminder that we need to always manage our portfolio to our comfort for risk, regardless of what we're seeing in the market, regardless of potentially what narratives you're listening to, paying close attention to. Make sure that you have a plan for how you're going to build cash when things start to shift. What areas are you going to pay attention to? Is it just the 20-day moving average? Is it a level below the 20-day? Maybe it's that horizontal range of support back here around 6,100 that was so important for us, Mike. That could easily be a level to which we decide to fall on any pullbacks. I'll note, Mike, that happens to be coincident with the 50-day moving average right now. So, some of these things are going to line up. And the other note, Mike, is that we do tend to get a little bit of weakness in the month of August as well. So, hey, when I say a little bit of weakness, Mike, we could see 2-3% drawdown in the S&P, and that could be absolutely within reason and bring us to an area of support pretty easily.
Well said, Kevin. And I kind of agree with you. As we're talking, I'm looking at the bottom of your chart and I'm looking at that RSI, kind of what you're saying right there. Number one, all clients should have a plan. They should always have a plan about how they're going to, react, whatever the bad news is. There's going to be bad news one day in the next, month, whatever that bad news is. How am I going to react? Do I have a plan? Hey, where am I going to create cash? And if clients are concerned and they're like, hey, 65 straight days, Kevin, 65 straight days, Mike, that the market's going up, maybe we can take some profits. It doesn't mean if I own 100 shares of ABC, sell all 100 shares, but maybe I go down to 75 shares. Take some of those profits off the table, raise that cash. That way, if the market should have a pullback, I have an opportunity like we did in April to be buying at the lows versus selling at the lows and panic selling. So I think everything you said, clients should certainly take that as a thought out, well-processed process that, hey, when the market's going higher, it's okay to take some profits. It's okay to reduce some positions and then continue to be able to participate with the market on an upward trend. So good stuff, Kevin. Good stuff.
It's hard enough to ride the trend when we start getting to the point where the trend is just seemingly unending. It can actually be more difficult to stick with it. And part of that process, I think a lot of traders have learned, is that by selling a little along the way, suddenly they're looking at their position size and they are now at a level where they can manage those bigger machinations, those bigger drawdowns and pullbacks. And then you find an area of support. And instead of being, stressed about the fact that you found support. You've been building cash all the while, and now you're looking at support going, all right, if we hold here, well, now I've got more money to put to work at this new higher low, if that's what we get. So it's always good just to be thinking about what might happen, what are the potential scenarios that could play out. That's our job as traders. Always be thinking about what could be coming next. Mike, as we led the show this morning, we noted lots of companies reporting. We're going to hear from a few of the big Mag 7 companies. We're going to be hearing from Meta, Microsoft, Amazon, Apple. It's a big week. The NASDAQ continues to provide leadership in the form of tech, Mike. My levels are pretty clear on this as well. Again, day 65 in the NDX above the 20-day as well. So all of that consistency that we talked about relative to the SPX is pretty much the same in the NDX. What are you watching in here?
Well, I think you said all the names, right? I think right now what we're seeing with the NASDAQ is anything associated with this word artificial intelligence. It's rallying every NASDAQ stock. I know you wanted to talk about the semis in a couple of minutes. The semis have been having a good week. I think I haven't been on with you probably in maybe about a month and a half, maybe even a little longer. Yep. And the semis were barely holding on the last time we talked. And now you see the surge in the semis. Again, I think the NASDAQ it probably went down a little disproportionately when it went down, I'll say late March, early April, and we hit those lows, and now we've rallied back up, broke out above, what was that double top that you have there at 222, and now we're kind of rallying past there. But it doesn't mean that one of these Magnificent Seven, some AI stock, hits a little bit of a pothole this earnings season. It could happen, right? And sure. I think your message is to be prepared for that. And I think our clients should certainly take heed to that. But also, the trend is strong, right? The trend is your friend, as they say. I hate to give, things like that. But yeah, the market's been trending up. The wind has been behind the market's back. The tariff conversation has been helping, certainly been helping with the NASDAQ stocks over the last couple of weeks. So I think all these things are good. We've got a huge week this week from the Fed, right? We've got the Fed coming out this week with a Fed decision. We've got unemployment report coming out. We've got economic data. We've got a Fed decision on Wednesday. I think I just said that. Yeah, these are big topics that the market's kind of tackling right now. So we can jump into any one of them, whatever you've been talking about. I watched a couple of shows. So I was off last week. Wanted to hear what you were talking about with your clients, but it seems like the same. Yeah, I don't want to say the same kinds of things, but it's been familiar topics. That would be the topic. It has. I would say.
Yeah, it's the truth of the matter is, Mike, we never know which of the topics is going to be the reason that leads to some selling, right? It could be any one of them. You called out hearing from the Fed this week. We don't expect changes according to the FOMC, the CME Fed tool, the one that shows us how traders are positioned. We don't expect changes at this point, but that doesn't mean it couldn't happen. But additionally, Mike, it could happen just by weak commentary from any of those Mag 7 companies could absolutely lead to a drawdown or a brief pullback or even an extended pullback. The point is we really don't know. And so as always, we just want to encourage us as traders to be thoughtful of the risks and comfortable enough with the level of investment we have to manage those risks. I often say, Mike, that sometimes we, as traders, we pick levels to which we are comfortable with the market falling. The problem is we don't pick those next levels below the one to which we're comfortable with. We leave those off the table and say, oh, well, the market's only going to pull back to here. I'm not going to worry. But then inevitably, it goes deeper than you expect, and that's when you find yourself making those decisions that are going against your process that are not ideal. We want to eliminate that emotional tie to our decision making as much as possible. I think that's a big part of it. So be thoughtful. Know how you want to act. Like we may say, Mike, for example, a good call out here would be that 50-day 22,200 ledge, which looks like support, Mike. But in the moment that we fall through that ledge, for one reason or another, right? If we do that, traders who didn't expect us to make that type of move are going to start getting antsy. And we as humans, when we get antsy and uncomfortable, the most likely course of action is selling. And that may not be the best course of action. It might be right, but it might not be the best. And that angst can kind of weigh on us as traders. Okay. And so that once more, hopefully gives you reasons to be thinking about, all right, if we can make this first level of move, where could we go to? And how is my current portfolio allocation going to manage that? Am I going to be okay, or am I going to be uncomfy? And that's when traders start to lighten up positionally, right? Try to build a little bit more cash. They get more comfortable to handle those pullbacks, becomes a little bit easier. So as always, be thoughtful. Mike, we're going to move over to our small caps. But as I do that, I want to address a comment that Karen made here in the chat. The comment just in relation to taxes. Look, one of the things we do not discuss in this particular class, or any of them, unfortunately, is the taxable scenario that traders can go through relative to trading in non-tax-free accounts, non-retirement accounts, your taxable brokerage accounts. So please be aware that can have an impact, but we don't discuss that here. We are not tax advisors. We do not make an encouragement one way or the other as it relates to your tax situation. Now, that said, traders who are taking profits will pay taxes. And by and large, we traders would rather take profits than we would losses. So that'll be the comment we'll leave you there with relative to taxes. Mike, the Russell's been playing some catch up, but a lot of that catch up maintains a recent uptrend here as well. What are you watching as it relates to the small caps, and what might be the reason we're seeing small caps moving to the upside nicely here?
I think, number one, when you look at the small caps, I think we could kind of look at them as, I would prefer to look at them as a leading indicator of where we think that the market might be moving to, right?
Okay.
And they're very tied to interest rate discussions, right? Because a lot of the profits that the small cap companies make, they reinvest them inside their own companies. And if they're reinvesting at a lower interest rate, they can get more bang for their buck versus reinvesting at a higher interest rate, right? So for me, with the small caps that I'm looking, I think that 23.15 right now for you, we would like to see it. And I'll say the market would like to see that kind of breakout, sure. Right? You just gave me an all-time high on the S&P 500. You gave me an S&P NASDAQ all-time high, and the Russell's kind of lagging behind. So could we potentially start to see these guys play a little bit of catch up? I think we can, and we're starting to see that. But I think it would be a good hurdle at that 23.15 for us to kind of break through. What would you need to hear for something like that? And I'm just giving two scenarios. I don't know what scenario that the Fed is going to say, obviously, on Wednesday. But if you heard a pretty hawkish, where we're going to keep interest rates higher for longer, if you start to hear that, I think that would probably be a big negative for the Russell this week. If you heard, hypothetically, Jay Powell decides to cut interest rates, surprising you, surprising me, and surprising the market, I think you would see these guys kind of rally. Right now, small caps, I think they're a little bit of a laggard in the market. It's a nice trend that they have. I do see a little resistance, a little bit above us at that 23.15, that critical level that you have highlighted right there. I think that's going to kind of give us a little bit of breathing room. The other side of it is your RSI under. You're not in overbought territory right now, right? So when we were looking at the S&P 500, when we were looking at the NASDAQ, the RSI at the bottom was in overbought territory. Overbought territory, we can continue to stay there. More likely than not, we're probably going to pull back in on that trend. So for me, I like the move that we're seeing in these guys. Like to see a little more strength, and the little more strength would be that breakout above 23.15. But right now, I think these guys are in a good spot, but they're really going to be sensitive to those interest rates going forward still. That's just the scenario of the small cap stocks.
I have to agree with you there, Mike. The one thing is that rates have really kind of settled down, right? The movement in rates has really settled. They're obviously we're sitting at around 4.4, but isn't it all tied to the rate of change? Because you're not seeing big moves here. And so the fact that we're not seeing big moves, I think, allows traders to digest the level that we continue to reside at in this 4.4% on the 10-year area. When we were running from here at our lows, when we were at 3.6 and we were running to 4.4 and higher to 4.8, that was something that we had to digest quickly, and that created consternation, as I recall. But it didn't Right now, the fact is we're back at 4.4, but it's a different 4.4 because we're not in the process of growing rates or yields climbing aggressively or falling aggressively. Perhaps the decisions or the commentary out of the Fed will have some impact on small caps here going forward. But I think that's what we need to keep a close eye on, obviously. Yields are going to have an impact. I noticed, Mike, before we move off of into the semis here, just briefly, a little lift in the VIX. Not a shock this week, is it? Right, with expected news, hearing from the Fed. This is a time frame in advance of that commentary from the Fed where you would expect some traders to be positioned to add some protection to S&P here, right?
I was reading an article. I don't know if I read it this morning or sometime. Oh yeah, it was on our internal stuff. The VIX, this was the lowest close on the VIX since Valentine's Day. That's what I read this morning. So if you think about that, we're in, that's almost 5 months ago.
Yeah.
And the volatility, you started out the show by talking about clients being complacent, and that's the danger. And that definition of complacency happens with the VIX. When the volatility index starts to go, and heaven forbid, we start to see below the teens. Right? Mm-hmm. Remember, for years, me and you were below the teens, and we couldn't even get to the word teen. It was like, it was 11, it was 12. We couldn't get to 13. We couldn't get it to break out above there. So volatility is low right now, and that always is I'll say, slightly dangerous specter for the market, because all of a sudden you can get that spike like we got in April. It just takes one thing from whether it's the president, whether it's a company reporting an earnings surprise that we weren't expecting, or a tariff deal that maybe doesn't come through or something like that. It could spike that volatility. But right now, complacency, I think, is, you said it for me early on, that's the dangerous part of the market. Well, hey, Kevin, it's just great. 65 new highs, 65 days in a row above the 20-day moving average. Hey, I could just sit back and do nothing for the rest of the year. My portfolio will be up, XYZ percentage. That's not true. I know that's not true. But that's what the market's telling us right now. And that's what you have that wall of worry, that term, that's why it exists. Right now, though, it'd be interesting to see if we actually broke down below and did get into something that was not a team. If we broke, it looks like we're apt to be breaking lower than having a reason to break above and go higher right now on the volatility index. So VIX makes me a little nervous. Obviously it drives a couple of different things. But yeah, I would say right now with the VIX at these lows, that's why you see the market at these highs. They have that inverse correlation. And if we started to pick up a little volatility, the market would pull off those highs and the VIX would start to climb, right? Yeah. That's what we would say.
That's true. And I think one other thing that's always helpful to be reminded of, everybody, is that these VIX spikes are the ones that are infrequent in nature, meaning we shouldn't, as traders, expect elevated moves in the VIX. We should expect reversion to the mean. So if the VIX falls to a level that we haven't seen in a long time, you should expect that to revert upward back to the mean. If we spike like we did back here in April, we should expect that to revert lower to the mean. That's the general process of the VIX. So always be thoughtful of that. It doesn't make as much sense necessarily to expect bouts with volatility, but rather to expect them, when they come, to revert back to the mean. That's generally a process that makes a little bit more sense. Okay, Mike, let's move into those semis. We're getting a nice move back here, upward through the 20-day moving average, which is notable. Mike, late last week, I was talking about how the SOX was battling it out at the 20-day. Everybody might have recalled this, those of you that were watching. You're paying attention to those. Guys, we closed above it still here on the 22nd. Looked like we had a test, right? We were below it intraday. We closed at 56.38. The 20-day was 56.24. The next day we closed at 56.37. The 20-day was 56.34. Closed above it. The next day, a doji right on it. Close 56.44. The 20-day 56.42, above it again. And then on Friday, lower intraday, but managed to close above it. Close was 56.45, the 20. Oh, excuse me, I'm wrong. Friday, we were below the 20-day for the first time, Mike. The 1 day below it on a close on Friday, and yet today we get this gap up. So the reason I'm bringing it up, everybody, is that we had what many traders, Mike, would say was a successful test of support last week, even though we closed below the 20-day one day on Friday of last week. Kind of interesting, no?
Well, number one, I'm going to bust your chops for 1 second. I'm not extending the Horner rule to the 20-day moving average versus the 200. Is that correct?
Kind of, to a certain extent, yes.
But
just looking
to
for
a certain extent, you know me, I'm having fun with you. But yeah, listen, I agree. Just everything that you just said. We were still, whether it's the 200-day moving average, whether it's the 50-day moving average, and in this case, it was the 20-day moving average, right? So you're using that. I was busting your chops about because you use the Horner rule on the 200-day, but it's the same thing. We're still touching that line, right? The close that you showed me 3 days ago, Friday, we did close below it. You pointed it out. And then today we got, get your rear end back above, and it got back above the 20-day moving average. So for the stocks, this has been a tremendous run, right? This has been a tremendous run. Even if you show from the beginning of the year, just the roller coaster that we've ridden on this has been a really strong move. And again, it's driven by, this is the topic of the market, right? Yeah. Artificial intelligence is what's driving these particular stocks. Obviously, the chips have everything to do with that. So it makes perfect sense. But I think go back to your wall of worry, go back to the volatility index. This is exact opposite of the volatility index. We're going higher as the volatility index is going lower. So when you start to, we're not rolling it. We are not. But when you start to get that cluster, like we have there, right where your white line is, where we're not really making new highs, we're not punching out above the 5,800. It could be one. It could be a slight pause, catch our breath from this tremendous move that we've made, and we kind of move sideways for a couple of days, a couple of weeks. That might be one. Or B, if we did make such a tremendous move and people are starting to take profits, as a client, maybe I want to start to think about where my stops might be on some of those stocks and where I might have some risk management strategies, because it's a pretty big drop off to your 50-day moving average. And as you pointed out, when selling comes in and we break through, I'll call it a support line, your white line that you just drew there, I hear what you're saying as using it as support. But if we kind of break down, that's a big drop off to the 200. I'm sorry, to the 50-day, the purple line. So yeah, for me, I like it. I like the consolidation pattern. I'm cool with that. It's something to keep an eye on. And you can see on your RSI on the bottom, we were able to maintain overbought for quite a while right there. Yeah. We went in that red zone. We stayed overbought. All right, we broke down below it. And now, look, it's curving back up on Friday, right? It curved back up today. So this is a good move. This is this is the index, obviously, that's kind of driving the market right now. That would be love to hear your thoughts on what you're thinking about the market.
I like all of that viewpoint, right? As you stated, leadership from AI, leadership from tech, leadership from semis. Big, important group. One thing for consideration, Mike, for a lot of traders might just be watching this ledge that we created as short-term support now. A lot of traders, if you're long, an investment like this, you might look and say, all right, if this were an equity, I would look for an exit strategy with that would have me moving on from this on a close under the white line, as an example. But if you're a trader investing in semiconductor stocks, another consideration might be if the semiconductor index closes below a certain level, maybe it's the white line, maybe it's the 20-day moving average for you, you can build in a conditional exit strategy that says, if this index is under a level, well, then I want to start selling my individual equities that are part of that index. That could be one way to think about it. A lot of traders, Mike, lean into just, I'm going to use an exit order on the stock itself. But sometimes it could be smart to consider the idea that, hey, if the group is going lower, then there's a chance for a bleed through move outside of my individual position's news, right? The stock that I own that just happens to be participating in that specific group. So that could be one way to think about it as well, everybody. You can always build that in with conditional orders on your individual positions. So, okay, Mike, some areas that are moving today. I noticed that utilities and real estate are off a little bit, probably tied to the fact 1 and 2, they both rallied last week, right? We saw Utilities make a breakout, and now you're getting a pullback to the breakout level with yields up a little bit today. That's not a surprise. Utilities and real estate both sensitive to interest rate moves. So these pullbacks make a little bit of sense. I noted that energy is up, and it's still in a bit of a channel here, but oil found a little bit of a bounce this morning, Mike, and I thought we could look at it real quick because it's needed to, if it was going to continue the upward trend that's been working since the double bottom back here, it's pretty much at a spot where it needed to get a bounce. In fact, maybe I should move my line, Mike, into this zone of support that we've just created in here. So yeah, this is notable because, last week we were talking about the impact of oil retreating becoming a disinflationary topic for us. That's a win for the overall market. If we're going to get a bounce here and see oil go back up above the 200-day and above 68, 69 a barrel, that could be a bit of a tailwind here, or rather a headwind for the market. Excuse me.
Kevin, I think a lot of this has to deal with, I don't want to, tariffs are not directly related to oil prices, but the effects on the economies of those specific countries that could be affected by tariffs had been something that had been an overhang a little bit for the oil market. Hey, if we have a 30% tariff, our consumers are going to, run and hide in Kevin's basement all day long, and they're not going to go out, and they're not going to drive anywhere, and there's going to be less demand for oil. I kind of find that sentence that I just said, I hear you, I understand it, but people are still going to do things, and people are still going to go out. So the sell-off on oil earlier this year kind of seemed a little over-exaggerated from my point of view. And where we are now, we worked off that oversold condition. We had a big spike, and now we've kind of pulled back in on oil. I think oil's kind of, I don't want to say doing its own thing because that doesn't make sense, but I think oil is minding its own business a little bit and kind of just moving back up based on these things, Kevin, supply and demand. And I think if we can kind of get rid of external factors of worrying about whether economies are going to keep growing or not and just go on supply and demand, I think maybe we could, find a little more stability in the price of oil. It's interesting, your pink line that you have drawn across, where that area was supports, I'll say, late August last year, September, October, November. And now, after that big sell-off earlier this year, now we're running right in there. Can we break through? And you saw late, about a week and a half ago, we tried to break through, but we pulled right back in. And your 200-day moving average acted as resistance, that blue line. So I think that combination of that, what was previous support could now become resistance, and the 200-day, interesting spot for oil. And I think, it's going to be more of, Fed, did we lower interest rates and stuff like that? Later on this week, as oil makes a move one way or the other, we'll use that as the excuse. But I think right now, I'm talking charting. I think I'm a little concerned with where the 200 is. I'm concerned where that previous resistance was. And maybe oil just kind of maybe continues to move a little bit sideways to work off some of the volatility it's had this year.
Yeah, that could be. I mean, that's as likely as anything else, Mike. If nothing else, though, we could just say, hey, the range that we've really traded in recently is 64.70 to the 68.5. I mean, really, if you're a trader and you're looking for something different, it would be outside of what I will say are these two green lines, right? Trading above 68.40 implies that there's more upside opportunity or a new move to the upside available. Under the green line down here at 64.75, more downside potential thereafter. In the meantime, anything that happens in between the green lines isn't necessarily decision-making opportunity for some traders. So basically just keep the trend viewpoint and go one way or the other based on which direction the break comes. It could be as simple as that. Okay, so there's your look at a few sectors. Materials also getting beaten up a little bit, but our leadership in terms of recent highs continues to be industrials, continues to be financials, and continues to offer technology. None of those are real shockers for us, everybody. It's been some consistent moves there over the last few months. So beyond that, Mike, let's get some stocks in the news today. We had some upgrades come through I thought we could look at. And one that I got to say wasn't expecting, believe it or not, is Nike. Nike has undergone a pretty good drawdown here off of highs. I'd have to change this to a 2-year chart to look at the length of this downtrend. There you go. That looks a little more consistent. But Mike, they got upgraded at JP Morgan today to overweight, had been at neutral, a new price target up nicely. Previous was 64, up to 93 now. The firm increased Nike's estimates for the first time in 13 months following its field work and talks with management. They see a multi-year recovery for the company, driving high teens to 20% annual earnings growth through the end of 2030 fiscal year. Now, Mike, all of that sounds good. Now, we know targets are never guaranteed to be achieved, but traders will look at that and say, hey, 20% premium to the price target price right now. But really, Mike, we could talk more specifically about the trend and suggest that the price action of late has really shifted something.
Yeah, I mean, it's. I think that gap up was on earnings a couple of weeks ago. I think it was late at the end of June. They had a nice gap up on earnings. They're in a strategy right now where they have a new CEO. He's implementing, based on the oversupply of inventory that they've had. Their big thing was where they were trying to work off a huge inventory glut. They had a ton of product. They also, they're obviously involved in the word tariffs as well, right? So the two combinations of an inventory glut internally for Nike, not because of anything else, and a combination of tariffs over the last year and a half has not really been favorable to Nike, right? Now, maybe they're working off a little bit of that inventory. Maybe they see some potential to get into some different markets. And again, one nice earnings report. I don't know that it completely changes the trend, but we are on the north side of the 200-day moving average. So it makes it feel a little bit better. And we're not just there for one day. We've been there now for about a week and a half, 2 weeks, maybe even a little longer. And if we came back down, then the 200 can act as support. So nice little upgrade for Nike. But hopefully that thing can continue going forward.
From the trend standpoint, Mike, as always, it's a matter of your time frame, right? For a lot of traders, this last oval I put on the chart here is going to be the big reason that they might consider owning Nike now. Having broken the downtrend, yes, we traded up. And some traders would say, well, if I'm a short-termer, this move through here, the fact that we've now gapped through the highs we've made in the last 2-3 weeks suggests that there could be more upside from here. And some traders in the short run could position a new entrance right below here, Mike, or an entrance at this spot and an exit right below it, or an exit under the 20-day could be comfortable. But for many other traders, Mike, they're going to look at all this and say, hey, the fact is we broke the downtrend. We rallied, came back and tested the 200, and they're going to look at the 200-day as an exit strategy under 71. Now, granted, that's a 10% zone beneath us. So you'd have to be thinking longer term, right, Mike? You wouldn't be thinking I could risk 10% on a trade that I want to hold for 2 weeks. Most likely, traders who are willing to risk 10% to the 200-day moving average are probably thinking about owning it for something akin to the 200-day moving average time frame, like 10, 11, a year, something like that. Does that make sense to you?
It does. So here's what I would say. I was looking at the longer-term trend when I first was looking at the chart. You just described the shorter-term trend, but then, I'm now picking on you, it's hard to have a shorter-term trend where I'd be willing to lose 10%, and I heard you very clearly say that you wouldn't be willing to do that, so I heard you say that. But if you look at this trend, so it gets confusing, right? This is a short-term chart that you're highlighting here right now. Truthfully, that's a double top. Yeah. Right? That's a double top right there that you just highlighted. So potentially I see 5 more points from 70 to 76-ish, about where it broke out last week. And now maybe I can go to 81, 81 and a half as a price target. Short-term trade. That's still helping the long-term trend because it's breaking out above that 200. But I kind of agree with you. The volatility on Nike has been very high over the last few months, even during the downtrend. So it's got a lot of volatility. But yeah, I think right now it's rewarding those from a short-term trade perspective. The long-term trade out there for buy and hold for the next 10 years might might not be, it might be forming. The cloud formation might be forming right now for that potential long-term trade.
But you know what, Mike? The reminder, I think, is that as we stated off the jump here with this particular look at things, time frame for the trader is what matters, right? Because if you're looking at this as we did on the weekly, well, then your time frame can fall back to a longer window of time. You're going to give it more wiggle room. If you're a short-term trader and you're thinking it can run to the white line, then you want to keep your risk factor nice and tight so that it makes sense to target something that's merely 3 or 4 points above us, right? You got to be willing to risk a proper amount. If you're looking to make $3, you got to be willing to risk something like $1 or less for many traders in terms of their risk versus reward approach. Always good to have a discussion on time frame, and also good to have some banter back and forth where we don't exactly say the same thing, I believe. So it's always nice to do that for our viewers. Let's hit a couple of more of these that are in the upgrade list, Mike. Texas Instruments got beaten up last week. If I'm not mistaken, it was on their earnings. Let me just throw back corporate actions application in there. There it was. So yeah, they got beaten up here. We're above the 20-day around 212, and then now we're trading at around 190. So they are well off. But according to Wolf Research, they've upgraded Texas Instruments to outperform. Previously, they'd been at peer perform. They've got a target now at 230 on the company, stating that the multi-year investment cycle is nearing an end and should drive free cash flow and margin leverage in 2027 and beyond. So that's the reasoning behind it. It's a little difficult, Mike, on a move like this to be a gutsy buyer when we're staring at the 200-day overhead.
Yeah, I think, listen, the chart doesn't look great. I appreciate the upgrade. I appreciate the RSI fish hooking at the bottom. I think in this example here, if I was bullish on TXN, I would try to maybe find an ETF that it was in. Given the chart that we saw in the semis themselves looked a little bit better than maybe specific player TXN at this point. But if I liked it and wanted to have exposure to it, maybe I would think about it via an ETF that had the semiconductors in it.
Yeah, that makes some sense, right? Something that would allow you to spread risk out as opposed to investing in one single security. That would certainly be a little bit more risky. I see where you're coming from there. Now, as it relates to the move itself, the fact that we've seen such an aggressive pullback, the one thing that some traders are going to look at and say is that, hey, we had a really good low that got bought up on Friday. Volume, as we've gone lower, has lightened up. And yes, today we're above the high of our low day in the pullback. So that might be an opportunity, but I think you hit the nail on the head with just your trend analysis, which is to say, hey, the trend that was in play is not any longer. And therefore the stock needs some time. You need to reevaluate what is the trend, and maybe you need more data points. For a lot of traders, it's going to be something back above the 200-day with some semblance of confirmation, whatever a trader might look to define that could be important. Guys, we got to wrap it up. I'm sorry, we are at time. Mike, it's a pleasure to have you on here, buddy. I really appreciate it. It's been a little too long for us to recover and come back together here in the show. So glad we could reconvene this morning. Thanks for being here.
Thank you for having me, Kevin.
Love it. And all of you, thanks for being here. Thanks for the conversation in the chat. As Jay Richardson's pointing out, we've got Scott Thompson coming up a little bit later with getting started, or rather beginner investing class. So check that one out. And big thanks to Mike Fairborn in the chat for managing all of that. Plenty more to come from us on the YouTube channel. Everybody keep it tuned right here. Make sure you're following Mike and me on X. And don't forget, if you like today's conversation, we'd appreciate that thumbs up. We're going to get this into the archives for you as quickly as we can. We hope we all have a great Monday, everybody. Look forward to seeing you all again real soon.